Hey there, my name is John Stevenson, also known as the Guaranteed Retirement Guy. I want to welcome you to the show because today we're going to be talking about something very important, and that is the right age to buy an annuity. So if you're older, typically most people in their 50s and 60s will buy annuities, but I have people reach out to me in their 40s who want to buy them. And then I have people in their 60s that are like, oh, I should have bought this a few years earlier. Maybe I should have, maybe you should have, maybe you shouldn't have. I'm going to show you whether or not that's true. Okay. Because sometimes it does make sense to wait. Sometimes it doesn't. So we'll take a look and then you can kind of be the judge. Again, if you're looking to buy an annuity and you're looking for someone who's transparent, who's going to show you everything regardless of what they're getting paid. I mean, you'll see in my videos, I show everything that's available. If you go to my website, johnstevenson.com, you will see all of the annuities that are available for every type of category. I'd welcome you to go there and check out my calculators, and you'll be able to see everything that's available based off of your criteria. So happy to help. If you are looking to purchase an annuity, I'd love to help you. So if you want to book a call, there's a link below this video, or you can do so on my website, johnstevenson.com, and we can I can answer your questions. And of course, I'm not going to hard sell you, but I would love to help you if you are looking for unbiased advice and you're looking for someone who's truly going to show you everything. So anyways, having said that, let's dive in. Okay, I want to just take a look at this with you and show you visually, because from my opinion, that's just the easiest way to do this. Okay, so I went in here and I just created a client that was 45 years old. So quite a bit younger than a lot of people who purchase these. Now, I do have people that will purchase these at this age. But typically when you're younger, you usually are more riskier. Usually, not always, but a lot of times people want to be in stocks or bonds. So I usually tell people, well, if you want maximum growth and then you want to do an annuity, then maybe wait a little bit longer. That's usually the standard answer for people looking to buy annuities younger. But sometimes it makes sense. And it just depends. And some people are in their 40s and they're well off and they want to have retirement income and they want to retire early. That's fine too. So let me show you how it would work. Now, I'm showing you first the income rider, then I'm going to show you the SPIAs, okay? And then let's talk about the age 59 and a half rule, because that's important to consider as well. So if we look at these, we'll say, all right, based off of this person, and I'm just doing this off 100 grand, okay? You take 100 grand, you'll know what the payout is for $1 million, because it's just 10 times that amount, or 500,000, that's 5 times. So it's very easy to figure out based off of that. So looking at this, and I did a joint, because a lot of people who reach out are married. Not everyone. I help a lot of people who are single, but a lot of people who are married want a joint payout. So we're going to start with that first. So looking at that, I'll just tell you right now, it's saying start income age 50. Why? Because income riders don't allow you to start income before age 50. Sorry. It's just how they work. They are the highest payout though. So if you're willing to wait that long, then I would definitely buy one. So anyways, based off of age 50, $100,000, it's going to give you $77.87 a month, a year, with North American. Okay. Then followed by American Equity, Allianz, and so forth. So not bad options for sure for $100,000. And that's income for life. I mean, I can go in here and I'll illustrate it for you so you can see what it looks like. All right. So based off of that, you're looking, yeah, you see that for life. And the account balance, even with growth, the account balance doesn't last forever. Last year, like 66, 67, and it's gone. So yeah, you're doing this for lifetime income. So if you take it out, you're taking out $358,000 from 100 grand. It's not bad. Now, what if you were to wait? And I would tell you, when people ask what's the best age, it's always like, well, if you can do it earlier, then do it, because you'll get more income. So let me show you what that would look like. So let's say you waited till 60 to take income. So you're deferring it for 15 years. It's $100,000, okay? 15 grand. Not bad. Not bad at all. If it's $1 million, you're getting $153,000 a year in income. If it's half of that, you're still getting like $75K. It's crazy. Think about that. $75,000 of income. That's, just from 500,000, that's joint forever. You're going to get your money back in just, a few short years, like what, 7 years, something like that, 6 or 7 years. Yeah. You get all your money back. So anyways, something to think about. But whenever you look at hindsight, this is the perfect example, because you're like, wow, 15 years, what a difference. Yeah. It makes a huge difference. What if you had 500 grand to invest at 45? Okay. And you wanted to take advantage of that deferral. There you go. 76,900. And the highest payout, of course, is American Equity. They're usually the highest when you defer it out longer. Not always, but usually they are. But you can see here, Yeah, they're going to take $1 million, multiply it by 7.69% and give you 76,000. If you take it earlier, this is the amounts that it would be. But again, and I said I'd mention the 59.5 rule. Even if this is cash, okay, the fact that you're putting this into a tax deferred account means it has the same rules as an IRA, which means if you take it out before 59.5, they're going to assess you a penalty. Okay. So it might still be worth it for you. Maybe at 55, you're like, all right, well, I'm going to take $62,000 out a year. You can see it's $1 million times 6.2. That's pretty good. You just have to realize they're going to charge you a $6,200 surcharge basically until you're 59.5. That is your penalty for retiring early. Totally not fair, but that's just how it works. I'm going to show you another option where that's not the case. Okay. So I'll show you here in just a couple minutes here. But anyways, it's a great payout. So you can see, wow, that's awesome. Okay. And if you're single, it's going to be higher. Let's see what it is. Yeah. 83 grand. Not bad. And you can see nationwide New Heights actually jumps up, but just barely. So they're still both on top and it's still great income. That's huge. That's huge from only $500,000. That's really good. So I'm not saying you can make more money in this in the stock market. I'm sure you can, but you have to be able to weather the ups and downs and it has to be perfect. Okay. So this is 15 years of perfect growth. Okay, and that's what you have to realize. And so hopefully it will, maybe it will, but you don't know for sure. This is guaranteed. This is just a way to take a portion of your portfolio and get guaranteed income. Now, you might be thinking, okay, well, what's the best age, John, for me to buy? Well, I'll just tell you, most of the time it's between 50 and 60. Okay. If you're going to retire at 62 or 65, if you can put money in earlier, I would do it. But you can't do it from a current 401k. If that's all your money, then you can't do it. You have to sever your relationship with your employer, or it has to be an old one. Okay, it has to be an old 401k because you cannot access that until you're 59.5. So that's the other thing to remember. Otherwise, you're going to have to take from cash or from another IRA. Maybe you have a rollover IRA from a past employer. That is where you can take the money from. So that is the caveat. I mean, that's the drawback really, is if you want to start this early and you want to put money in at 55, you just need money outside of a current 401k that with your current employer that you're putting money in within right now. So anyways, that is just something to remember. Otherwise, even if you're 60 and you're thinking, I'm going to retire at 65, it's still good. You're still going to be way better off because you got 5 years of deferral that's going to give you a whole lot more income than just getting it as an immediate payout. Now, sometimes people just aren't in this position. They're like, well, I can't access my money until this age, and that's just how it is, and that's fine. We can still get you a great payout. I just want you to see illustrated how these numbers work, okay? The longer you let them grow, the better they do, okay? And all of them are very similar. You can look at this one with Athene. Athene's not bad. They're not the highest payout, but it's just, it grows the same. So when you look at these, see, very similar growth rate. Athene's not beating them not because they're benefit based. Their benefit base grows pretty well. Okay. They're just not beating them because their withdrawal rate's not as high. So whenever you're looking at growth and people are pitching annuities and they're saying, well, this gives you a 20% bonus and you get all this and you're like, wow, this is great. This is great. Why isn't John showing me this? It's because it's not the highest payout. It might give you a huge bonus, but you only might have a 4% withdrawal rate. And when it comes to taking income, who cares? Okay, who cares how you get there? So I'd rather have a 0 bonus product and a 7% compounded rate if my withdrawal rate's higher than everyone else and I'm getting income higher than everyone else. That's all I care about. Okay, so that's what you have to focus on. It's not just the bonus. It's not just whatever their participation rate they're talking about. They're getting in the weeds. Okay, it's really important just to talk about income because that's what it's about. If you're looking for lifetime income, that's it. Okay, you just need to look at the highest payout. So let me just dive in this just a little bit more because when we're looking at the best age, I also wanted to show you what it would look like if you started this later. Okay, so we already know what it looks like if you defer it. Okay. Now, if I was going here and let me just say you are 60 now, okay? Let's say your spouse is 62, just to spice it up. Okay, we'll go in here and we'll say, all right. So now I got the same 500 grand, okay? We already know what it'll give you deferred for 15 years. But I have 500 grand now. I want to take income right now. There you go. 32 grand because you did not give it to the company for a long time to grow. Now you're probably looking at this thinking, dang it, I wish I had money when I was 45. Yeah, we all do. Okay. But most of us don't. Most of us don't have income we don't have the lump sum investment until later, which is normal. And so what do you do in this case? Well, most of us don't retire at 60. Okay. There are some lucky individuals that do it, and I do help those people. But a lot of people don't retire until they're 62 because they want to take Social Security, or 65 because of Medicare, or maybe 67 for full Social Security. So what you want to do is say, all right, well, I've got this money in a 401k. I can now access it. So now I want to lock in some income for myself. This is a great time to do it because rates are very good. So now if you defer it out 5 years, what does that look like? What is the best annuity contract for deferring out 5 years? All right, Nationwide. There you go. Still, that's pretty good. $52,000 a year, and that's joint, okay? It's really good. Now, if it's a single payout, go and take a look at this. 55. So definitely higher when they're only on the hook for one life. So if you're thinking, well, I really want to work till 67 because I got higher Social Security, I want to get my full Social Security, I want all that's owed to me, then I'm going to wait, I'm going to wait then to take my annuity. You can do that too. There you go. It's like 65 grand. So and that's for a single payout. If you did joint, there you go. 58,000 to 60. So it's not a bad time to buy if you're looking to defer it out a couple years. If you can't defer it out, that's fine too. Sometimes it's worth it to just let your assets grow and then just pay a larger premium for an immediate payout. That's okay too. Don't feel like you missed out because you didn't. It just depends on your priorities. If you want higher growth in the market and you're willing to let it sit there exposed to risk longer and take more premium to take an immediate payout early on, you can do that. There's nothing wrong with that, and I have tons of people that do that. I just wanted to illustrate how this would work. Always in hindsight, when you look at these, it's usually better to lock it in and let it grow and defer for a few years before you take income. So, but that's why I tell people all the time, go to my website, check out the calculators and see for yourself, and then reach out to me. Okay. So that's what I would recommend. Go to johnstevenson.com and check out what the payouts would be for you. And then if you would like to buy an annuity with me, I'd love to help you. Okay. I do these all day long. I do hundreds of these and I show everything that's available. Okay. I don't care what company it is. I mean, I do recommend the companies that I recommend as far as safety. I think that's very important. But at the same time, I'll let you see everything that's available. Okay. Because commissions are all over the place with these. And it's a whole lot easier for you to at least make a decision based off of being informed than just having something pitched to you by an advisor who's getting paid a ton for it. So anyways, that's the way I work. I like being transparent. Hopefully that resonates with you. And again, if you want to book a call, there's a link below the video or there's a link on my website, johnstevenson.com. So I'd be happy to help you there. So I hope you enjoyed this video. I hope that you found value. If you did, make sure you click the like button, subscribe, share, comment below, and we'll see you next time.